Hey friends, I'm back. It's good to be here, like that track from Diggable Planets. I'm so excited tonight because I want to share with all of you a stock, a deep discount value stock that I have been buying weekly as of late. My patrons already know that. I'll link to my Patreon in the pinned comment. I know that this stock right now is going to be controversial with the community, but I'm excited about it because it's a company in transition. They're paying a staggering 5.8% starting dividend yield. And I believe that the dividend is sustainable and that it will be covered by earnings as of this year, 2024, and that the company will forge a path forward, although Wall Street right now does not see what I'm seeing at least. And so there is some risk as well. This stock reminds me a lot of AbbVie back when I was buying it, when they were facing the Humira patent cliff, and there was a lot of uncertainty whether Humira and whether AbbVie, for that matter, would forge a path forward. Fast forward a few years, and that stock and that company have done quite well. They figured it out. And another stock actually that took longer to kind of find its footing, but it's been in the news a lot this week, is IBM. I bought IBM a number of years ago, another controversial company. A lot of people thought, hey, this would never find its footing again. But it now just so seems that they have reimagined their future. They're getting on the right track. And the stock has surged, absolutely surged in value this week. The turnaround can sometimes take a lot longer than one thinks. In the case of IBM, that is. And so the stock I want to discuss today, it's Pfizer, by the way. I know this one might be a little controversial. I just talked about a controversial stock in the last video, Altria. So it'll be interesting to see in the comments below what everyone has to say. But right now, Pfizer is facing its turnaround moment. Sales from their drugs related to the pandemic are completely drying up. They have inventories at the company now that they're having to just write off. They're facing some challenges with their numbers. 2023 is looking like a poor year. They haven't released the full year results yet, but when they do, as of Q3, it's looking like a poor year in terms of earnings, but 2024 is looking a lot more promising. And so for me, when shares are down almost 40% from the 52-week high, it's trading at a forward PE multiple in the 12s as I look at 2024 estimated earnings. And I see a yield that is very meaningful to me that I can use to pay my bills right now, a 5.8% qualified dividend yield. I get really excited about that for my own dividend stock portfolio. So get ready, everyone, for a really exciting video. Welcome to PPC Ian. This is dividend stock investing for everyone. All right, everyone. It's been a while since my last video. Thank you for your patience. I have been working extreme hours at work, and so that's why the videos have been spaced out a little bit more than I would like. If you enjoy the video today, if you appreciate the video, please don't forget to subscribe. Also, please don't forget to click the like button. It means the world to me. I have one slide. Check it out on the screen right now. I have summarized everything in one slide here to make it easy. And so on the left-hand column, you just see the regular stats for Pfizer. I actually bought it just this last week at $28.71, the week before at $28.42. Off of the $28.71 purchase price, you can see that I bought it when it was down 38.6% from the 52-week high. You can see there the earnings estimates both for 2023 and 2024. 2023 places the PE for 2023 at an 18.5, which is pretty high for this company and for this industry. You can see 2024, however, that PE forward dips all the way into the 12s, which is a little low for this particular company. And I believe that the PE could dip even more as earnings recover. The dividend right now is 42 cents a quarter or $1.68 a year. And so the yield is a 5.85%, and that's a qualified dividend yield. So it's taxed as long-term capital gains, which is really awesome. It's a meaningful dividend that I can use to help pay bills. Payout ratio for last year, 2023, is above 100%. But looking forward this year, it's down at 74%. And so I do believe that the dividend is sustainable. In fact, they recently increased the dividend, not a lot, but a little. I don't think they're going to cut the dividend here. That is the bet I am making for my personal situation. And so when I look at these types of turnaround plays, again, I put this in the same categories like an AbbVie or an IBM. The way I look at it is I am just collecting the dividend. I'm not even buying for capital appreciation, although it'll be nice. I think it will appreciate in value over the years, and it makes me feel good. It's nice. But I buy for the dividend. And I have two types of dividend stocks I own. I have stocks where I'm reinvesting the dividend, and I have stocks where I'm not. Pfizer is a stock where I'm not reinvesting the dividend, and the reason is I am taking that cash flow and I am using it to help pay bills. And so when I look at a stock like this, I am really looking at it for the dividend alone, and I am looking at it, can they continue to pay this dividend and perhaps even increase it over time? My belief is yes. Wall Street, I'm not sure if the street agrees with me. The street is pricing this stock right now as if it's going to face a lot of trouble, not only with 23, but with 2024, 2025, and so forth. And I'll get into that in a minute. As you can see on the screen in front of you right now, I have a few more stats on that leftmost column. What you want to take note of here is they have been increasing the dividend on average by 3% per year, but I'm not so sure that's going to hold up. Market cap is pretty strong at $162 billion. This company has scale. This is a winner-takes-all society. I like companies that have scale. And you can see my two recent purchases there as well. Now, it's back at prices that have not been seen since 2014. So you have to go back 10 years in time, basically, to see the price that it's trading at right now, which is great for someone looking to buy value that is looking to buy sustainable, higher yield. Now, here's where things get really interesting. In that middle column, I just did a few comparisons of their 23 guidance versus what actually happened kind of pre-pandemic. 2019, the pandemic started at the end of the year, so I think that is a really good year to look at. But I also look at 2018 because it's a true year pre-pandemic. But I don't even think they started selling their drugs and vaccines in 2019. And so again, I think that's an interesting comp to 2023 because we're just taking out those years where they had those runaway sales and runaway earnings that they stockpiled and later used to acquire Seagen. I'll get to that in a minute. But basically for 23, they are anticipating as of their Q3 report that revenue will come in around 58 to 61 billion and that adjusted diluted EPS will come in between $1.45 and $1.65. Now, it's interesting because the analysts are coming in right in the middle. They think $1.55, which obviously does not cover the dividend, which is $1.68. Now, if we go all the way back to 2019, revenue is substantially lower. Their revenue back then was $51.8 billion. So certainly revenue has gone up over time, but obviously we can't pay dividends with revenue. We pay it with earnings. And earnings back then were way higher at $2.87. Now in 2018, earnings were $1.87. And so you can see right now it's trading at 2014 prices, and probably for good reason because earnings in 2023 are not even going to meet their 2018 earnings. Although 2024 earnings are going to exceed 2018, but not quite match up, not quite do as well as 2019. And so you see it right there. Why is the stock down? The stock is down because the earnings are bad. And why are the earnings bad right now? The earnings are bad because they really were making a ton of money these last few years off of the pandemic. But the pandemic is over. And so that is one of the reasons that earnings are down. Another reason that earnings are down and probably could face some pressure for the next few years is they face a series of patent cliffs in the United States with some of their popular drugs that they make. I actually just read an article before I published this video that was so insightful. I'm going to link to that in the pinned comment below. I also have a link there to my Patreon as well if you want to check that out. But in the article, it went into detail about the specific drugs and how much revenue and earnings they account for at this company. And so you're facing a situation here where not only are they losing and even taking charges against the drugs that were related to the pandemic, but they have other drugs that are on the patent cliffs because drug patents here in the United States only last so long. I think it's about 20 years. And sometimes there's extensions that can be applied. But nonetheless, this decade, throughout the rest of this decade, they're going to have to make up for that loss. I think also, though, why are earnings down so much? I think during the pandemic, these guys started spending a lot of money. And you can see evidence of that, in fact, as you check out the screen again. I took note of this in the third column. That's where I have all of my notes about this company. You can see they have a cost realignment program. They're actually going to save $3.5 billion through the end of 2024. That's a lot of money. So it sounds like they reported this cost realignment program, say, when they announced their Q3 earnings, which was end of 2023. And they think they can save $3.5 billion through the end of 2024. That just goes to show how much they ramped up just probably some unnecessary costs at the company during this time when they were doing really well. And I think that's natural human tendency. I think human nature is to think that a trend that's happening will go on forever. And I'm sure that the managers at the company, the executives even, probably didn't fully anticipate that there would be such a drop-off in sales of the pandemic-related drugs. But here we are, and here we are needing to cut some costs. And so those are probably the biggest drivers right now that are affecting the earnings. But I have some other thoughts as well. So as you can see on the screen in front of you right now, it's interesting. So this is a company that needs to make up for these drugs, not only the ones during the pandemic, but also just some of their bellwethers that are dropping off of the patent cliff. And so they made a large acquisition recently of a company called Seagen. This was $43 billion. They probably used, or I know they used, a chunk of the money that they earned during the pandemic to acquire this company. This is a company that is developing solutions and treatments for cancer. Now, the thing about Seagen, though, and they've made a string of acquisitions over the last year, smaller ones, and over the last few years, smaller than Seagen. Here's the thing about these acquisitions each time I look at them. The company pays a lot of money for the acquisition, but the acquisition itself doesn't have a very meaningful contribution to the bottom line right away. I'm going to go back to IBM. It almost reminds me of Red Hat. IBM paid a ton of money for Red Hat, but I knew Red Hat, when they made that acquisition, it wouldn't be very meaningful to the bottom line right away. But what would happen over the years of integrating Red Hat is it would change the culture at IBM. It would probably bring in some really great engineering talent, some new best practices, and over the years, it could possibly transform the company. And here we are with IBM surging in share price this last week. And I look at an acquisition like Seagen and some of the others that were made at Pfizer. Similarly, they paid a ton of money for this thing. But honestly, it doesn't have that meaningful impact to the bottom line, at least proportionate to the cost of this acquisition. But over the coming decades, they are making a bet here that with Seagen and with the other acquisitions that they made, that they can replace some of these drugs that are falling off of patent cliff. And I think, in fact, their pipeline has like 18 or 19 new drugs that are hopefully coming to market very soon here. And that was the article I read as well that I'll link to in the pinned comment, was talking about that strong pipeline. But I think Wall Street they're not really going to believe in this pipeline until they see the pipeline come to fruition. And we just don't know out of this pipeline, will they have the next blockbuster? That's always the risk with a healthcare company like this, a pure play pharmaceutical company. Can they have a Humira, for example, come out of these 19 drugs in the pipeline? Could they have the next vaccine? What will come of this pipeline? Wall Street doesn't know. And so they're pricing this thing as if probably the pipeline is just not as strong perhaps, or isn't going to contribute that much. And so let's keep looking at the slide. As you can see on the screen right now, I have a few more thoughts I want to share with all of you. And so I want to talk about, well, as I said, the patent expiration cliff, but they do have a strong pipeline. I'm not buying this thing for capital gains. I do believe that they will pay and grow the dividend. And I do believe there will be capital gains over the very long period, but just look at the chart. This isn't the stock really to buy for long-term capital gains. I look at this as a stock to buy on weakness for dividends. And there's many ways to invest. I have different types of stocks in my portfolio. The ones where I'm reinvesting are the ones that typically have lower dividend yields and that I'm trying to compound and that I'm buying for future yield on cost, and they'll probably have some great capital appreciation as well. This is not one of those companies. This is a company where I would call it an income factory light. For those of you who follow Stephen Bavaria and follow my friend Dividend, the Dividend Monster, Greg over on Instagram, those types of investors subscribe to the income factory philosophy. I would kind of call this an income factory light. It's a dividend stock. It's a dividend growth stock, if you will, although the dividend grows slowly, but it's not a 10% yield or anything like that. So you can see that it's a, probably for me at least, I look at it as taking on lower risk while getting a pretty darn great yield in my world of higher yielders. And it's a stock I already own that I've owned for a while that I'm very comfortable with. Let's keep going. As you can see on the screen in front of you right now, all the way on the right-hand side, that last column, it's an ancillary position for me. In fact, it's only 0.77% of my portfolio. And so that's part of the story as well, is I can add to this thing and it will still be ancillary. And so I don't plan on making this a top 10 kind of position or anything like that, but I'm happy to add to it here because healthcare overall, it's only 11.6% of my portfolio. I could see that going up to say 14, 15%. I'd be fine with that. In fact, I'm seeing some value over at J&J as well, and I plan on buying some J&J. It has a PE right now at 14.9. I think there's some concerns over at J&J just with litigation risk. But here's where I'm at this year. It's an interesting year for me, 2024. And so I made the big Altria purchase. You guys know about that if you saw my last video. I'll link to that in the pinned comment below. That has brought that one up to a core 5 position for me. It's my number 5 largest stock now. I would call that not only income factory light, I would call that an income factory stock, like a Thug Life income factory stock at that almost 10% yield. And so that was that big trade. That's probably the last big trade I'll ever make in the sin stock category. Now I'm just de-risking by taking all that cash flow off the table and using it or reinvesting it elsewhere. I have made some trades recently in Realty Income. It has risen in my portfolio, actually the number 7 largest position now. Again, I'll link in the pinned comment, but I talk about that on my Patreon. I actually made a larger trade in Realty Income today. I've bought in the high 40s recently, but I even bought some today in the 55s, last week in the 56s, I think. And I'm kind of done with that though. And so this year, as far as my strategy and my kind of strategic imperatives, is I started off the year with an income factory stock, made it number 5 in my portfolio. I started off the year again with another kind of, I'd say, income factory light stock, which would be Realty Income, and I made it number 7 in the portfolio. I don't want to add too much more there because I don't want to be overexposed to real estate, because I'm a real estate professional by trade and I do real estate outside of the dividend portfolio, and so I've got to mind overall allocation to real estate. I look at the pharmaceutical sector and I see something like Pfizer. I look at that as an income factory light stock ancillary position. It's probably going to be a focus of mine weekly for quite some time here, as long as it stays where it is, because I see it like an AbbVie or IBM. It's just going to pay me to wait. It's going to pay that dividend, and I am fine with waiting, even if I have to wait decades. Don't care about the share price. I'll add to J&J. That one is different. That's one that's on reinvestment. And it's yielding, about 3% right now. And so it's not a high yielder. It's not an income factory stock. That one for me is a yield on cost stock. It's one where money I'm putting in today will not really add value to my life until 10 years or so, or maybe even 15 years into the future. And then the yield on cost will be pretty great. And it'll be at that time, the tranche I buy today, an income factory light type of position. I was also thinking this year, hey, maybe I would add to RTX. But RTX right now surged in share price, so that one for me is off the list. That was going to be my strategic imperative this year, to basically have a stock, a kind of a pet project stock that I would be focused on that would be more of a dividend growth stock, even more so than J&J. It would be a compounder. I see that company that way, but it's kind of run away from me here. So at this point, I would say for the remainder of 2024, at least as of right now, the stocks I'm really looking at are the two big pharma positions in my portfolio, or two of them. I also own AbbVie, but Pfizer and J&J, and probably leaning towards Pfizer right now because I just see value. And so that's where I'm at, everyone. Share in the comments below what you think. Hopefully this doesn't get too heated or too controversial, because I know there is a lot of controversy over what transpired just in our world, in our country over the last few years, and it all centers around the pandemic. And so I'm just looking at this thing from a pure numbers and investing standpoint, not trying to look into anything beyond that. But let me know in the comments below if you enjoyed the video. Don't forget to click the like button. Before I go today, in terms of a full disclosure, I am long the stocks mentioned today. I am long Pfizer, ticker PFE. I am long Johnson & Johnson, ticker JNJ. I am also long AbbVie, ABBV. I am long Realty Income, ticker O, RTX, ticker RTX. I'm long IBM, ticker IBM. I think I got them all there, but if I forgot any, I'll include that, as I always do, in the description as well, where I have all my disclosures and disclaimers. In terms of a friendly disclaimer today's video, it's not investment advice. I'm not a licensed investment advisor. I'm just sharing my journey here on YouTube for fun and entertainment. If you're going to go out and invest in the stock market or anywhere else, please consult your licensed investment advisor first. I'm just sharing my journey here on YouTube for fun and entertainment. It's possible to lose money in the stock market. Certainly the stock discussed today carries risk. That's why it is on sale. There is always some kind of reason that a stock is trading at these kind of levels. And Pfizer certainly has its obstacles to face over the coming years. All right, everyone, I'll see you in the comments below, and I'll see you in the next dividend stock investing video.